Good day, ladies and gentlemen, and thank you for standing by. Welcome to the Caribou Coffee First Quarter 2010 Results Conference Call. As a reminder, today's conference is being recorded. At this time, all participants are in listen-only mode. Following the presentation, we will conduct a question-and-answer session. Instructions will be provided at that time for how you queue up for questions. I would now like to turn the conference over to Ms. Adelia Rodriguez, ICR. Please go ahead.
Thank you, Paul, and good afternoon, everyone. Caribou Coffee's First Quarter 2010 earnings press release was distributed this afternoon after the market closed. If you do not have a copy, one may be found on the website at cariboucoffee.com in the Investor Relations section. Joining me today are Mike Tatterfield, President and Chief Executive Officer, and Tim Hennessy, Chief Financial Officer. Part of our discussion today may include forward-looking statements. These statements are not guarantees of future performance, and therefore undue reliance should not be put upon them. The company undertakes no obligation to update any forward-looking statements in order to reflect the events or circumstances that may arise after the date of this conference call. We refer you to Caribou Coffee's recent filings with the SEC for a more detailed discussion of the risk that could impact the future operating results and financial condition. During this call, management will discuss financial terms such as EBITDA, which is a non-GAAP measure. While this is a non-GAAP measure of financial performance, management believes it is a common and useful tool in evaluating the company's performance. A reconciliation to comparable GAAP measures can be found on the last page of today's press release, as well as on the website in the Investor Relations section. Following the presentation today, Mike and Tim will be able to answer your questions. With that, I would like to turn the call over to Mike Tatterfield, the CEO. Mike?
Thank you, Adelia. Good afternoon, everyone, and thank you for joining us this afternoon. I'll lead off the call by updating you on the progress we are making on our strategic initiatives, and then turn the call over to Tim, who will walk you through the highlights of our financial performance for the quarter. As many of you know, our team has spent the last year and a half balancing a financial turnaround while building and executing on our long-range strategic growth initiatives. During the latter half of 2009, we were able to devote a greater portion of our time, energy, and resources on our longer-term growth strategy of building a multi-channel branded coffee company utilizing 5 key levers across our businesses. Those levers are drive retail coffeehouse average unit volume, unit growth in company-owned coffee houses, grow our consumer packaged goods coffee business, gain stronger presence in the food service sector, and expand the unit growth in our franchise and licensed channel. Our strategy is taking hold, and we are seeing positive signs of traction across all 3 lines of business. Today, we reported consolidated net sales growth of 11% for the quarter. Each of our business channels contributed significantly to the growth in our top line, which reinforces our optimism for our ability to transform into a multi-channel branded coffee company. Net income for the quarter was $1 million, or 5 cents per diluted share. This is up from $300,000, or 2 cents per diluted share in the comparable quarter of last year. We believe this quarter's performance is reflective of our commitment to deliver profitable growth each quarter while continuing to invest in the areas necessary to expand the Caribou brand through our multi-channel growth strategy. I'd like to take a few moments to walk you through some highlights from each of our business segments. Within the coffeehouse segment, increasing the average unit volume of our coffeehouse is the biggest opportunity and our top priority. I am happy to report that we are having success. Comparable coffeehouse sales were up 5.2% in the quarter, which beat our internal estimates. We are focused on growing average unit volume 2 ways: drive increasing levels of traffic into our coffee houses, and increase average check by increasing beverage, food, and bean merchandise sales to our guests. To drive traffic, we have ramped up our marketing and product management initiatives to make sure Caribou Coffee is top of mind for our guests. We launched our New Boo marketing campaign in March, which provided a fresh new look to our brand. New Boo is focused on our guests and our culture, and through this initiative, we are making sure that Caribou Coffee is the community place that our guests love. We have changed the look and feel of our products, point-of-sale messaging, general merchandising, as well as our website, to provide a more youthful and playful look, more representative of our culture. These include new branding efforts highlighting our Booisms, which are simple and fun little phrases that remind our guests of all the things in life to stay awake for. Our focus on product management has demonstrated to our guests that Caribou is committed to providing premium product and outstanding value. We are differentiating our brand through the introduction of new premium products such as real chocolate-based beverages, wholesome oatmeal, and distinctive teas. At the core of these product introductions are the consistent themes of premium quality, all-natural, and customizable offerings. We handcraft each of these offerings to our guests' individual tastes, and the feedback has been tremendous. We believe our guests want an extraordinary experience, and these products investments are driving loyalty and frequency. The next extension of this product philosophy will be found in our breakfast sandwich launch. We are currently in test at 45 locations, and we look to add 100 to 150 stores in the back half of 2010, with a full rollout in Q1 of 2011. The combination of these marketing and product investments working together to build traffic and average check is the first key step to unlocking our long-term AUV growth strategy within the coffeehouse channel. In terms of new store development within the retail coffeehouse segment, I'm happy to announce that we have recruited a head of real estate for our development team. This was an area that we had scaled back on during the last 18 months, but will be a key component of our longer-term growth. For the remainder of 2010, we will be primarily focused on rebuilding the development team and real estate pipeline. Building high-quality real estate and people pipelines will be key success metrics, and we will not compromise on our discipline to do this right. I would now like to transition to our commercial and franchise and license segments. Combined, these businesses grew by 52% in Q1, continuing a very strong trend of quarterly growth. Our commercial channel, which is comprised of CPG sales of our packaged coffee, Keurig sales, office coffee, and food service sales, was up 58% in the quarter. This segment continues to grow in prominence for us, and the first quarter made up over 13% of our total revenues, compared to 9% in the first quarter of 2009. We have benefited from our strong growth in distribution throughout 2009, and our market share of the premium category now stands at greater than 4%. As we discussed last quarter, we have invested significantly in marketing support programs to expand our distribution outside of our core markets. We are confident that Caribou Coffee offers exceptional quality coffee in the premium category, as well as tremendous value for the consumer's dollar. Our team is actively engaged in executing our strategy to drive trial and increase turns in the stores we are in today through a blend of trade promotional investments, along with consumer brand awareness programs. We will continue our focus on this business, as this is an area where we see potential for significant growth for many years. Our partnership with Keurig remains strong. We have added blends to provide a broader range of Caribou flavor profiles that can be found in a single-serve format. We anticipate that this partnership will also benefit our growth moving forward. Before turning it over to Tim, I would like to reiterate that we are pleased with the progress in our financial performance, which allows us to engage in our long-term multi-channel branded coffee strategy that will fuel significant growth for Caribou Coffee. Our first quarter was another positive step towards these efforts. I will now turn it over to Tim.
Thanks, Mike, and thanks to everyone for joining us today. I'll walk through our first quarter results, provide you some color on the remainder of the year, and then open things up for your questions. As Mike mentioned, our first quarter consolidated net sales of $67.1 million were up 11% compared to the first quarter of 2009, with growth being driven across all segments. Comparable coffeehouse sales were up 5.2% in the quarter. This was driven by a combination of improving traffic as well as an increase in our average ticket, which has been fueled by incremental food sales, primarily driven by the introduction of oatmeal. Our commercial business drove a 58% increase in top line for the quarter. This growth in sales was attributable to growth with our existing customers and 2,400 new doors added during the second half of 2009. Throughout 2010, we are focusing on continuing to increase our turns across our all existing doors, while strategically targeting select new grocery partners who can build on our ACD base. Our franchise and license business grew their top line by 36% in the quarter. This was driven by a combination of new stores open in the second half of 2009, as well as some product sales shipped in the quarter for stores yet to be open. Our gross margin was 53.2% in the quarter. This is down from our full year 2009 gross margin rate of 55.9%. As the sales mix from our commercial and franchise segments continue to grow, this impacts our blended margin at a company level. In addition, we invested in higher levels of trade promotional programs in our commercial segment and invested in higher quality product platforms launched in our retail coffeehouse segment. These investments are part of our core brand building strategy. For the quarter, operating expenses increased by approximately $1.6 million, driven by variable costs related to our higher sales base, as well as the marketing and product management investments that Mike mentioned. As a percent of sales, operating expenses of 37.2% decreased 150 basis points, providing evidence of leverage we are achieving on our strong top-line sales performance. In the quarter, we invested approximately $1.1 million more in marketing and product development than we did in the comparable quarter of 2009. Much of this is driven by the premium quality, all-natural, and customizable product offerings and brand-building initiatives that Mike spoke about. It's worth noting that in Q1 of 2009, we had scaled back on this type of investment spending as part of our cost management efforts. This is a good example of the balance we are maintaining and selecting the key areas for reinvestment back into the business towards our multi-channel growth strategy while maintaining our commitment to bottom-line growth. Depreciation and amortization expenses of $3.1 million decreased by $600,000 in the quarter. This decrease was from our lower depreciable asset base and reduced capital spending over the past 2 years. On a full-year basis, we do expect depreciation to be slightly lower than the prior year, as depreciation related to the new capital investments will be offset by the declines in existing asset-based depreciation. General administrative expenses of $6.5 million decreased slightly over the prior year. This was primarily due to the cost rationalization efforts in 2009. We expect our G&A run rate to increase in future quarters as we begin to round out functional areas necessary to support our top-line growth. EBITDA of $4.6 million was relatively flat compared to the prior year. We are pleased with our top-line growth, which has enabled us to increase operating investments back into our business for the future. As I mentioned earlier, during the quarter, we invested an incremental $1.1 million in marketing and product development towards products launch and products and tests within our retail coffeehouse segment during the quarter compared to Q1 of 2009. In addition, we invested an incremental $1.5 million in trade promotional activities and marketing within our commercial business. For Q4 of last year and in the current quarter, we are lapping very minimal investments in these areas in the prior comparable periods. As we look forward, we will begin lapping more comparable levels of these types of investment spending and anticipate showing EBITDA expansion in the remaining comparable quarters of 2010, which I'll discuss later. For the quarter, we reported net income of $1 million or 5 cents per share, which is up from 2 cents per share in Q1 of last year. We ended the quarter with $17.7 million in cash on hand and no debt. During the quarter, our main use of cash was for normal seasonal working capital requirements, as well as inventory builds supporting our growth. In terms of the remainder of the year, we expect full-year sales to grow between 5 to 6% on an as-reported basis, which equates to 7 to 8% growth when normalizing for the 53rd week in 2009. We now expect that our retail coffee houses will drive comparable coffeehouse sales of 3 to 4% on a full-year basis, with some flattening out in positive comps expected over the course of the year, given what we are lapping in the prior year. If you'll recall, we were lapping over negative 5% comparable coffeehouse sales in Q1, whereas we will be lapping over slightly positive comps in Q4. We project our commercial sales growth to be in the 35% range on a full-year basis. We are expecting net earnings of 39 to 42 cents per share on a full-year basis, which would reflect solid growth on the 26 cents per share we reported in 2009. As a reminder, the 53rd accounting week in 2009 added 2 cents a share in earnings for last year. We plan to deliver quarterly growth on earnings in each remaining quarter of 2010 compared to the respective prior year, following our historical seasonality patterns. From a capital investment standpoint, we estimate full-year spending to be $13 to $15 million for the year. These capital investments include product management initiatives such as ovens, maintenance capex in our stores, new unit build-out costs, and some investments in our support center facility. That concludes our prepared remarks for this afternoon. Operator, could you please open up the line for any questions?
Yes, sir. If you'd like to ask a question, please do so by pressing the star key, followed by the digit 1 on your touch-tone telephone. If you're using a speakerphone, please make sure that your mute function is turned off to allow your signal to reach our equipment. Once again, that was star and then 1 to ask a question, and we will pause for just a moment. All right, once again, that was star and then 1 to ask the question, and we will take Jonathan Komp with Robert W. Baird first.
Hi, thanks. It's Jonathan Komp calling for David Tarantino.
Hey, Jonathan.
Hey, guys. How are you?
Good.
Just a couple of questions for you. Maybe to start off with a little bit of a broader question about the quarter. I know that you said retail comps exceeded your expectations internally. Would you say the same thing about profitability, or did you choose to invest some of that back into some of the initiatives?
We chose to invest that back into some of the initiatives, taking advantage of where we were seeing things during the quarter.
Okay, thanks. That's helpful. And then maybe if you could expand a little bit more on the strong same-store sales that you had. Maybe if you had a little bit more color what you think is driving the strength, if it's entirely some of the new products that you rolled out during the quarter, or if it's the base business improving as well.
It's a combination. I mean, we've been fundamentally working on trying to improve our operations. So as you get operating performance and traffic starts coming back to our business, we've been seeing a traffic uptrend since Q4 of last year, with programs such as, Happy Monday, where folks are able to engage in the brand. And then we've translated that as we introduced the Real Chocolate platform that came in December and January, the front part of the year, and that kind of accelerated some of the momentum in traffic. And then when we introduced the strategy, as we started talking about introducing new platforms to the system, such as the cereal platform that came in with oatmeal, that added a significant growth vehicle inside of our stores. So we look at that, and as I talked about food, as we look at going forward in the back end of the year, we're in test in 40-plus stores in the Minnesota and D.C. markets, and we're looking to see how we expand that to 100, 150 stores at the back end of the year. But that is our mindset, clearly there's momentum in the business as we're seeing the guest experience, giving us credit, and then the new products that we're rolling into the business as well.
Okay, thanks. That's definitely helpful. And, curious, have you seen that momentum continue into Q2 so far? Is that true?
Yes, we have.
Okay. That's helpful. And then one last question on the marketing efforts and specifically the rebranding that you recently underwent. I'm curious to hear more about the consumer reaction to that and if that's continued to help trends or what you've seen from those efforts so far.
Very positive. It's both from an internal consumer, as our team members, you really basically, how is Caribou, its culture, and how does it represent itself both internally and externally? There is a lot of really interesting side benefits that come from this, but you're seeing this in our new webpage. You're seeing in how customers talk about the brand, and when we're integrating that with what our product strategy is, it starts to connect. And that's one of the things that we were trying to do is we didn't come in here to kind of just change everything that's been done in Caribou, that has a pretty good history and a pretty strong DNA. What we came is how do we evolve it so that it can actually continue to, capture the customer's attention. And, as we bring in these new products and you start to show where the brand's going, it clearly starts to differentiate what we are and what we're not. But clearly most of the things that we've seen and even the feedback that we get have been very positive.
Okay, thanks. I'll jump off and let a few others on.
Okay,
thanks.
And next up we'll hear from Colin Guheen with Cohen.
Hi there, Colin. How are you?
Very well.
Good. A couple questions. I know we don't have the segment margins, but how'd the commercial kind of profit margin come out? I know that was lower in the fourth quarter. It sounds like there were some similar drivers occurring here in the first quarter. And then how does that play out for the rest of the year? I know you've been aggressive in the commercial side of the business to drive volumes.
It improved in the quarter relative to where we were in the fourth quarter, and obviously that's part of what we're doing as we're managing the business forward. As we entered in, the heavy door volume that I talked about in the last half of last year, we went into those knowing that we were going to need to support those doors. So we did improve our margins in the quarter, but still down obviously from the comparable quarter of a year ago. But the trend line is what we're managing to.
Okay, and then behind your comp guidance, actually first can you just walk us through kind of the calendar one more time for the rest of the year as things roll into the stores, and then how much of that is baked, I guess, into that 3 to 4% comp guidance, or is it just basically initiatives you have in now that you feel you can drive that 3 to 4% comp with?
Well, again, we've been launching platforms, right? So we will be continuing to extend our platforms. So, right now we've just shifted to a blended or an iced chocolate platform, which will then, we introduced tea in the first quarter. We're going to a different version, an iced tea, but a distinctive iced tea platform in the second half of the summer. So the things that we spent as the first half of the year focusing on introducing, we will do line extensions of those platforms as we continue to move forward. And we have other new products that we are, in test still today to see, how those are going to continue to perform. Plan on launching those in the back end of the year, as well as we keep on rolling out our sandwich program. So the guidance is a combination. We are getting the traffic is continuing to stick. People are coming back to our brand, and they're coming back across all of our geographies. So that's a very positive sign for us.
Great. And I guess the competitive environment for drinks, it sounds like there's going to be a lot of QSR news around drinks and maybe some pretty low price points out there. How does that kind of, does that enter your competitive or your strategy work heading into the summer?
Yeah, we always look at competition, but we have our strategy. We have an affordable luxury strategy. We do focus on premium, handcrafted, natural, high quality ingredients. So we are different. So do believe that that is what resonates with our guests, and that's where we're going to continue to move forward with.
Okay, and then just one last numbers question. A number for G&A for 2010. How much growth, I guess, over 2009 are you guys expecting?
Well, we'll be managing the G&A line in terms of, we know we have some positions to round out yet in functional areas, and we'll be doing that over the quarter and basically manage that within, kind of a 10% of revenue range. So, as we can, build the top line and then fill in on some of these resources. So that's kind of how we guide it.
Okay, great. Thanks a lot.
Yeah, you're welcome.
Our next question will come from Mark Argento with Craig-Hallum Capital.
Hi, guys. Good afternoon.
Hey, Mark. How you doing?
Good, thanks. Could you talk a little bit more about the food and kind of what you've seen so far, or what your experience has been overall with the 40 or 50 store test, and what works, and then thinking a little bit more about kind of that next tranche of beta stores. Are those going to be all store-owned? Do you have any plans to start doing any kind of franchise stores, and just some thoughts around that?
Okay. Initial feedback that we're getting from guests is meeting our expectations. Things are working as we like them to see. So, we are continuing to look forward to planning our rollout as we had to get to 150 store. We are focused primarily right now just in the morning, handheld sandwiches. So that is going to be where we're going to be spending a lot of our attention. We will be eventually looking at what does the afternoon sandwich program look like, but we'll be getting that into test probably at the back end of the year. So looking at something like that to continue in 2011. From an expansion, on the second part, I believe you're just saying, was it expansion, Mark?
Yeah, just what are your thoughts in terms of that next tranche of stores and okay. And then also, I guess, tacking onto that, what do you guys, how do you look at the opportunity? You're making an investment in capital into the equipment and the installation, which is, I think you guys have talked to the $25,000 or $30,000 investment. What kind of AUV growth and kind of margin potential do you see there? Because, I think if you look back at history, some of your competitors earlier in their life stage, I think, had really added material AUVs with the food platform. So I just wanted to kind of get a better understanding of how you see that ramp and what the potential is.
Yeah, so first off, just going from the morning day part, as we take on the, rolling the sandwich program, our goal is to be system-wide in Q1 of 2011. So, we're very, we will look at this to make sure that, the operators, this is new, right? So we continue to make sure that we can execute at a high level, and we really do value that the experience has to be outstanding as we continue to get into the new category for us, i.e. baking food in our stores. So that'll roll from, our current market geographies, and then we'll just, expand on the 150, most likely be in the Minnesota marketplace as we expand forward, and then continuing on to the rest of the system in Q1. In terms of, we've always looked at what the potential is as we look at our current AUVs, that are a little north of 550,000. We look at the food platform and, again, our aspirational model. That's what could be one day as we've used the term that $1 million target. And we looked at food in the combination of platforms somewhere in the range of 150,000 to 200,000 in terms of the total food program. But you're talking about a morning day part, a lunch day part, a dessert day part, all kinds of food products. So getting the foundation of getting ovens in is one of the critical key components that we look at, and this is the investment of how do we step up. And that'll, clearly is what the consumer's looking for is they want a exceptional quality food item that matches the exceptional quality beverage that we bring. And that's always been the strategy, but you have to do this is we will go to where the bulk of our transactions are first, which is in the morning day part. Make sure that we perform very well there and then extend that into the lunch business and then look on at adding what are the other key elements. And we have a high bar.
Do you expect, would you be able to add an afternoon day part within the kind of the first year of having these, the platform rolled out, at least the ovens installed, or kind of what's the gating factor there?
We again will go through Q1 of getting the breakfast program in, but we will be testing lunch. Pretty much probably in the back end of the year. We think that's again another opportunity because our beverage opportunities also translate into the lunchtime hours. And folks continue to ask us, what product offerings do you have for lunch? And we have to be able to match those offerings. So we'll be testing that, but we think that's a pretty good opportunity for us as well.
Sure.
And clearly see doing the same type of it'll probably roll much faster because the reason why we're doing a disciplined roll right now to the store system is you have to actually install the oven base, making sure that team members get experience with product, but once they have the understanding of doing the foundation, you can go quicker with the afternoon or lunch business.
Sure. And, thinking a little bit broadly in terms of overall pricing, traffic, as the economy gets, hopefully a little stronger and get some better employment numbers here, any thoughts around starting to bump up pricing again? Any opportunities there?
Yeah, there's always opportunities to do some price optimization. In fact, this month we did a bit of that already, but clearly, that's always something on our radar. In terms of balancing quality, product platforms at the right price point for our guests.
Okay, and more of a housekeeping question. Do you, Tim, do you have a number for the stock comp expense in the quarter?
$250.
Great. I think that does it for me. Thanks, guys.
Thanks, Mark.
All right, before we move on to our next question, I'd just like to remind everybody that it is star one to ask a question. Well, next we'll go to Rick Ferrum with Creative Capital Partners.
Hey, Mike and Tim, congrats on another nice quarter here.
Yeah, thanks, Rick.
Last quarter, you had projected 1 to 3% comp growth, and you're now increasing that pretty significantly here to 3 to 4% for the year. Can you just shed some light on Q2 comps at this point and how you're tracking?
Yeah, we're tracking at about the same level in the first quarter, and I'd say that going into the year, everybody, including ourselves, were being a little cautious about what to put out there, and obviously now that we've got one quarter behind us, it's still early. We like what we're seeing in Q2, but obviously there's a lot going on. And as we talked about in the call, we'll be lapping later in the year some higher comps from last year.
Okay. And on the marketing side, are you still sort of at that $2.5 million spend rate that you were at in the first quarter, or do you expect that to ramp up?
No, in fact, we'll have a bit of decline because we did have some incrementally higher marketing around oatmeal launch, tea, our new brand, New Boo. So Q1 was a bit higher than what we'll see in some of the subsequent quarters.
Okay. How are things progressing with the U.S. food service partnership at this point?
It's still in infancy, right? So as we're getting into, there's 6 houses today. We're working through all the nuances with their sales force, and even having more top-to-top discussions as to how do we expand this to broaden it to a much wider audience. This isn't to go quickly. This is to get it done really right, making sure that we have the resources and they have the right sales and training allocation to ensure that we can transition. They are clearly looking at Caribou to be their premium coffee provider so that they can penetrate into other accounts as well as transition from some of their current coffee to Caribou as well. So it's a huge upside for us. This is one that we're just being really diligent about making sure that we execute. So as planned, we're working through it. But we expect to see a lot more traction of this at that probably the end of the year as they start to really roll this out to their client base and get a good understanding of our product.
Okay. Does the relationship preclude the company from going direct to any national chains in the meantime?
No, we can actually have those conversations as well. Some we might include to bring U.S. food service in. Some we might be doing direct. Right? We try to look at this as a total partnership. But again, we would be looking at, is this something that they're better to serve, or are we better to serve?
Okay, and is that an initiative that's underway, or is that the latter half of the year kind of thing?
No, those are ongoing as we speak.
Good. And that's great news. And the oven installation, it sounds really transformative for Caribou in 8 months. And I guess just with respect to some more color on the Minnesota and D.C. tests, can you share what same-store comps have looked like in those units, understanding that you're really only selling morning baked goods at this point and you haven't broadened that to the afternoon or evening yet?
Yeah, I mean, what we're looking at, to give you an idea of how we look at the business, because, we can look at the comps. But when we launched oatmeal, we were looking at doing we break down things into like 3 units per 100, so that really translated to about a 1% increase on same-store sales. What we're seeing with the food program is about a 1.5 to a 2% increase when you talk about the sandwich, or 5.5, 6, as we think about it. But it's fairly consistent.
Okay.
And the challenge that you have on that is you also take away oatmeal, right? So it's figuring out how the full food program works, because it's not just 100% incremental. you do actually cannibalize some of the other food programs as you continue to add more food. So that's why we're looking at this and figuring it out. But that's why I said you could almost say that we're looking at about a point, again, like similar to oatmeal, you're looking at the incrementality of the business. But again, early days, you're in just 2 test markets, and we want to roll this out, and you see when you get a full range of 100, 150 stores, you get a much better view as to how is it going to play. This is new to Caribou, so this is something that we really have to execute well, all the way down to the supply chain, all the way upstream as well.
Have you been able to put any marketing muscle behind that effort in those markets yet, or is it?
What's interesting is you don't really require that much because, especially as the consumers become aware that we have a sandwich program, and if you were saying that at a point of purchase in the store, and people said, "You do have sandwiches now? I'll try one." So it's actually, we're getting this type of growth without a lot of marketing spend.
Great. And can you just update us on the stock repurchase program? Were you able to buy any shares in the first quarter? And do you expect to get more aggressive ahead of the growth initiatives expected in 8 months?
No, we acquired 10,000 shares in the quarter. The board authorized the plan, but we're not actively out there at this stage.
Okay. And is there any color you could share on what your major shareholder may be thinking about? Obviously you're not inside their heads, but has there been any discussion that you can share with us about their holding and what their plans may be?
No, there's nothing been going on there.
Okay. Thanks, guys, and congrats again on a nice quarter.
Great. Thank you.
Next up, we have a follow-up from Jonathan Comp.
Hi, thanks, Tim. I just wanted to quickly clarify a couple of the comments you had on same-store sales to date in Q2. I think on the last conference call you said comps to date had been about plus 4%. And so if I'm back into kind of the March run rate, it might be closer to plus 5 or 6. I was just curious, is Q2 similar to the March run rate, or is it similar to the Q1 rate overall? So could it possibly be closer to the plus 6 range, or?
We were running 5.2 in the quarter, and that was the number that I was referring to, is that we're in that through April, we're in that 5% range. But we do see, as you look at our historicals, we are anticipating that percentage to decline as we're lapping better numbers, just from a trend line perspective. Does that clarify for you?
Yeah, that's very helpful. Thanks for clarifying that. And then just one other follow-up question. I think you said you expect commercial and franchise sales up 35% for the year. I just want to make sure I understand the reason why that.
Sorry, our commercial sales would be in the 35% range. That would exclude franchise and licensing.
Okay, and the reason why that's flowing from the Q2 rate of plus 52 or plus 59%, is that just related to lapping some of the grocery?
Exactly. That's why we had called out in our comments the 2,400 doors that we added in the second half. So you've got sales in this first half of 2010 to customers and doors that did not exist in 2009.
Okay, that's all I have. Thank you very much.
Yeah, you're welcome.
Next, we have a follow-up from Colin Goheen.
Hi there. Just one clarification. What was the actual commercial sales number in the first quarter, excluding franchising?
Excluding franchise, call it $9 million.
$9 million. Okay. And I guess on this topic of lunch, maybe more generally, how do you lunch is more complicated, I would imagine, than kind of a hot breakfast sandwich rollout.
how do you really prepare the stores in the back of the house to handle kind of that undertaking? And what stages are you in? I don't think we should be thinking about that as a 2010 or 2011 initiative, or maybe just give us a feeling on timing.
You wouldn't
seems like a pretty big prize, but yeah.
Right. You wouldn't see a lot of benefit of this till the back end of 2011 if we were successful in doing it. We don't see doing too many things strategically different along the lines of what we're doing with it. You know, we would be looking at a hot sandwich profile that would, you know, oven baked again and finished at the store level. So very similar from, you know, what we're doing in the morning day part. So we do look at how we're taking this to, you know, we might have different offerings. You know, if you said, hey, if you had a quiche or something else like that you decided to move, again, fitting that handheld that would be matching what the consumer is looking for. But we anticipate very similar is we're going to find a unique niche, again, that natural high-quality product line that we will be able to do at the same speed that we can do our morning breakfast part and translate that into a lunch business. And then, you know, eventually you start thinking about, again, it's platforms that we're trying to bring into the business, translate that into other, you know, dessert opportunities that can move as well. But this is a long-term build as to how do you start building platforms into our business. And, you know, again, we'll start being experts in the morning.
And the other thing, you know, we're looking at our leverage points. As Mike says, you know, when we build with those lunch sandwiches, it's how do we leverage that investment in the oven operationally, manage it similar to the morning part, and leverage the labor.
Okay, so fair to say a lot of your volume estimate for the program will be or is estimated to be driven at breakfast, at least initially.
Well, at least, sure, definitely, yeah.
Okay. Great, thank you.
I have a question from Ken Holton with Ham Fun.
Yes, good afternoon, gentlemen. Going back onto the commercial business, one of your competitors talked about pricing pressure, especially selling into the grocery markets, and I was wondering if you've seen anything on price in your markets.
Well, there's definitely a lot of trade promotional programs going on in the marketplace. It really differs by market, and frankly, by grocer for that matter. So we see that's part of what we're responding to. In addition to the promotional activity that we're doing with support we're providing to some of our grocery partners and new doors that we've added.
And what is the total door count now on commercial?
We're at about 7,000 doors. And that would.
Do you think you could take that?
I mean, I'll answer that. I mean, the potential is 18,000 doors. It isn't a race about getting more doors right now. It's really about trying to be real focused and driving the velocity, in the existing door base. And then also looking at the same way we approach the retails, what other product lines, is the consumer looking for in those doors that we would be able to, bring in newness to that business. But first, it's established at 7,000 doors and making sure that we drive the brand awareness and velocity first. And yes, there will be door growth within the geography. We are in the, once you include the single cup business with Curd, we're across the United States. So, but we want to be pretty focused in, our core geography where the majority of our doors are, which really tends to be more of the Midwest going towards the east than towards the west.
Great. Thank you very much.
That does conclude our question and answer session for today. I'd like to turn the call back to Mike Tatterfield for any closing or additional comments.
Great. Appreciate everybody for being on the call and look forward to next time. Thank you.
Thanks, everyone.
That does conclude our conference call for today. We thank you for your participation.